Hello. In this session, we will learn how behavioral finance emerged as a response to the failures of standard finance theories to explain real-life financial market phenomena, especially the anomalies. So in this session, we will learn how behavioral finance emerged as a subfield of finance, how rational standard finance theories describe the world and fail to explain some of the phenomena we observe in real life, and we will understand the concept of financial market anomalies. So we will learn what anomaly means. To understand what anomaly means, we should first see what normal is according to the standard finance theory. So I will start with an introduction of the standard finance theory. And in order to be able to understand this introduction, you need some terminology. A major concept we use in finance is return. And in most simple terms, it is defined as the percentage change in the price. For example, if the stock price has risen from $10 a share to $11 a share, it represents a 10% increase. So this 10% is the return. The second scientific word we have to learn is autocorrelation, in particular return autocorrelation. So you know what correlation means. It's a coefficient that represents the relationship. If it's a positive number, then it means two variables move together. And if it is a negative number, they move in opposite directions. Return autocorrelation means the correlation between current period's return and the previous period's return. That is, the return today and the return yesterday. Standard finance theory expects this autocorrelation, this return autocorrelation, to be equal to zero. That means by looking at the previous day's price movements, you should not be able to predict today's price movements. But in real-life financial markets, sometimes we observe significant, statistically significant, positive or negative autocorrelations, which imply that by looking at the yesterday's market return, we can predict what will happen today. Standard finance theory says returns are unpredictable. We call this concept random walk theory. That means stock prices, exchange rates, bond prices, they just move randomly in an unpredictable manner. This concept is called efficient markets theory. Efficient markets theory means all available information that is relevant for valuation of a financial instrument such as stock is already and instantaneously reflected in stock price, so that using that information, you can't make money in the stock market. So it should be impossible to design strategies that exploit that information set to make profits. So standard finance theory says by holding a stock many periods, on average, you will earn a return which is proportional to its risk. So simply, you should avoid trying to beat the market. You should decide on how much risk you want to take, and you should construct a portfolio that is suitable for your risk preference, and you should buy and hold it forever. Standard finance theory predicts that expected returns should be proportional to the risk, as seen on this graph. As we move to the right on the x-axis of this graph, we are taking more risk, and as you see, the expected return, which is on the vertical axis, on the y-axis, is increasing together with the risk. So, the more risk, the more expected return. For us, experienced real-life practitioners, this is a quite naive suggestion. It is indeed too naive that using some of the techniques like technical analysis, fundamental analysis, and our experience in trading strategies, it is not that difficult for us to read the market. So we're not going to take the standard academic advice as it is. But let's learn the terminology used in standard finance theory. Every stock should earn a return proportional to its risk. So this is compensation for taking that level of risk. This is called expected return. The term expected should not mislead you. It actually means required return. It is what is a suitable compensation for taking that amount of risk. But in every period, on every day, a stock or any other financial instrument may bring you a different return. So the difference between expected return and the actual realized return is called abnormal return. So let me define the term abnormal once again. Actual return minus expected return. So this is the part of the return that is not a compensation for taking risk, but is probably coming from somewhere else. Possibly new information arrivals, surprises, or previous mispricing being corrected, or a new mispricing being created due to behavioral biases. So, according to the standard finance theory, which we can call efficient markets paradigm, abnormal returns should be unpredictable. So, expected return can be predicted because it's a function of the risk. Realized return minus expected return is the abnormal return, and it is unpredictable according to the finance theory. As both an academician, having worked on all these academic theories for many years, and a real-life trader with 27 years of experience, I would say this argument of the standard finance theory is both correct and false at the same time. You will see it is possible to beat the market in many cases, but you will also see it is quite difficult. When trying to do so, you may lose money in many cases. As you may have already guessed, standard finance theory turned out to be wrong in many cases. That is, it cannot explain what is happening in real world. Especially, there are many statistically documented anomalies. We name the behavior of the stock market that doesn't conform to the predictions of the standard finance theory, but rather create predictable abnormal returns and profitable opportunities for investors as anomalies. Now I will provide you a list of major anomalies observed in financial markets. The first one is short-term return continuation. Using the technical analysis terminology, short-term trends. in many cases, the market goes up for some period, and then it continues to go further up. So there are trends. And in technical analysis, we have the saying, trend is your friend. Most traders make money by following the trends. That's an undeniable truth, which standard finance theory, academic approaches cannot explain. The second anomaly is reversals. So we have both continuing trends at the same time, but also reversals. That is negative autocorrelation. So I think this is the time to use our new terminology, return autocorrelation. The short-term momentum, that is trends, means positive return autocorrelation. Today's market movement being similar as yesterday's market movement. This was the first anomaly in our list. The second anomaly is just the opposite, reversal. Well, it is negative autocorrelation. Today's market movement is the opposite of yesterday's market movement. So in financial markets, we have both momentum and reversals. And to exploit these patterns, we have two types of strategies. The first one is trend following or momentum strategies. And the second one is contrarian strategies to exploit reversals. Now you might be curious about how come we can have both momentum and reversal in the same market. It is because they occur on different time horizons. Now, let me summarize the major previous research results for you. A study by Jagadesh and Titman in 1993 has documented evidence of the momentum strategy's profitability. If you buy winner stocks of the last 3 to 12 months, and if you sell loser stocks of the last 3 to 12 months, and if you, after forming this portfolio now, if you hold it for the next 3 to 12 months, and you will make a profit, you will beat the market by 1% per month on the average. This is a statistically significant anomaly which violates the predictions of the efficient markets theory. But over longer horizons, we have reversals. DeBont and Thaler, 1985, have documented evidence of these long-term reversals. The winners of the previous 3 to 5 years tend to become losers of the next 3 to 5 years, and vice versa. The losers of the past 3 to 5 years tend to become winners of the next 3 to 5 years. You can see the performance difference of past winners and past losers in this graph. As you see, a loser long winner short portfolio would earn about 36% in 3 years. That is approximately 2% per month. So we have momentum over a 3 to 12 months horizon and reversals over 3 to 5 year horizon. We have also a short-term reversal pattern, which might be more interesting for us, the short-term traders. There is a daily or weekly reversal pattern. The winners of this week tend to be losers of the next week, and the losers of this week tend to be the winners of the next week. So we have a very short term, 1 day to 1 week horizon reversal pattern, a medium term momentum, and a longer horizon reversal again. So in financial markets, especially in the stock market, both momentum and reversal occur in the same market, in the same stocks, but at different time horizons. Another interesting anomaly is the 52-week high strategy's profitability. George and Planck, 2004, has shown that if you buy those stocks which now trade close to their 52-week high, you will beat the market by 1% per month on the average. And we have the most mysterious pattern, which is bubbles. Starting from the tulip mania of the 18th century, bubbles have been recurring again and again, despite its catastrophic consequences for some investors. The financial community doesn't seem to have learned any lesson to avoid any bubbles. They still repeat the same mistake. So in our graphs, I will show you what bubble is. A big, sustained movement which persists for a while and then completely, or at least almost completely reversed. This is a bubble. Although academicians and financial market community are aware of the bubbles, they still commit the same error, creating bubbles followed by bursts. Most recent example is the Nasdaq bubble or the housing bubble in America, which caused the 2008 financial crisis. And most probably nowadays, in 2015, we had a bubble in the Chinese stock market. So at the bubble peak points, the stock prices are way above their fundamental values, so a bubble represents a mispricing. It is really astonishing for finance professors to understand why bubbles still happen. There must be some irrational forces behind it. Rational theories can definitely not explain bubbles. It's probably some behavioral biases involved in the formation of bubbles. And finally, the Nobel Prize winner Robert Shiller has shown us that the stock market is too volatile compared to the fundamentals. In this graph prepared by Shiller, you can see a proxy of the stock fundamentals, time series over time. As you see, they are not much volatile, but the stock prices compared on the same graph are much more volatile than fundamentals. But that is, investors in the marketplace at an excessive volatility. Too much movements in one direction and followed by reversals, and then the opposite movement in the opposite direction, and then once again followed by a recovery. Actually, the fundamental value of the firm doesn't fluctuate like this. It is much more stable. So, just human beings are creating an artificial volatility. So, as an stock market anomaly, we have excessive volatility relative to fundamentals. And one final type of anomaly, probably the most interesting one, is the calendar anomalies. We have Monday effect, very low or negative returns on Monday, or we have the January effect, and we have the Halloween effect, which means sell in May and go away until October. So maybe I can summarize this for you. If you enter the stock market in October and hold your position until May, you are likely to earn a positive return on the average, so you are likely to make money. But between June and September, you are more likely to rather lose money in the stock market. This is called Halloween effect. These are quite mysterious. We still don't know scientifically what is the real cause of them. There are some hypotheses. There is some partial evidence that would support these academic hypotheses, but they are still under debate. Obviously, behavioral finance theories can be of help here. In many cases, where the standard finance theory cannot explain these anomalies, usually behavioral finance theories are successful to account for what is happening in real world. So to explain these anomalies, we still have some rational theories which may sometimes be explaining some of the anomalies or part of them, and we have behavioral theories which appear to be relatively more successful. We cannot fully attribute all of the anomalies to irrational behavior or psychological biases. Some of them may be rational. For example, the excessive volatility documented by Schiller may be due to changes in people's risk perceptions, and these risk perceptions may be rational, but it is highly unlikely for these rational changes in risk perceptions to fully account these excessive fluctuations and excessive volatility in the stock market. So our conclusion is that we should believe both in rational theories and in behavioral theories. So we should adopt a synthesis of them. We should combine them, because in real life we can find situations where in each case one of these particular type of theories apply well and help us to save money. So in this session we have learned that real life stock markets do not behave as prescribed by the rational standard finance theories. We have anomalies which create predictable patterns and profitable opportunities for investors. And finally, rational standard finance theories cannot account for these behavioral anomalies. We need behavioral theories that incorporate irrational behavior and psychological biases to explain these anomalies. Next, we will have a series of 7 sessions. In these sessions, we will discuss each of these behavioral biases one by one individually. In each of these sessions, we will describe the behavioral bias and its psychological roots. We will discuss how it may affect individual investors and what stock market anomaly it may cause.